This video will help you understand the 2025 tax updates that are applicable to most taxpayers out there. If you don't know who I am, my name is Chris Dime. I'm a financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. Now, every year there are changes to the tax code, and we're not going to exhaustively cover all of them today, but we will touch on the ones that are applicable to most of the client conversations I'm having as it relates to contribution limits, retirement accounts, etc. These updates will be applicable to 99% of the families that I speak with, so let's jump in. So the first major update that occurs pretty much every year is an inflation adjustment to the various brackets that go into determining how much you'll owe in federal income taxes and federal capital gains taxes. Now, your states might have their own rates, and those might have changed as well, but we're not going to jump into state-level state taxation today. On the federal level, those brackets change, and as opposed to going through each one of them, I'll just link down below to a hyperlink to the IRS where you can see if your brackets have changed. And this is the same thing with IRMAA brackets, or income-related monthly adjustment amounts. I'll push out a future video on exactly how IRMAA functions, but to keep it very simple, based on what your modified adjusted gross income was in the tax year of 2023, that will dictate how much more or not more you get to pay for various parts of Medicare in 2025 moving forward. And while I call them IRMAA brackets, or you might read about them as IRMAA brackets, in reality they're more of like IRMAA cliffs, whereby if you earn past a particular threshold, your Medicare gets more expensive as a flat dollar increase. There's no like phasing into a dollar increase. You're either over or you're under a particular threshold. You're either over or you're not over the cliff. So again, I'll touch on this more in a future video, but just know if you're past particular income cliffs, which again, I'll link down below, that means you're going to pay more for Part B and D. And there's various escalating levels of those cliffs. Okay, so the biggest tax update that I think is important to know is the increase to 401k contribution limits. And this also applies to 403bs, 457bs, etc. Another name for 457b is deferred compensation plan. So regardless of your income, the maximum for 2025 is $23,500. For those of you who are under the age of 50. If you're 50 or older, then you get an additional catch-up contribution of $7,500. And so that means if you're 50 or up, your maximum 401k contribution for the tax year of 2025 is going to be $31,000. All that money can be pre-tax, all of it can be Roth, it can be a combination of the two, but not to exceed that $31,000 limit, or if you're under 50, the $23,500 limit. Now keep in mind, this extra catch-up contribution has had some recent legislative changes said about it, particularly as it pertains to the Secure Act iterations that have come out in the past few years. Now, the good news is nothing is changing for 2025, but the IRS is predicting that in 2026, for those of you who are considered highly compensated employees, your catch-up contributions of $7,500 or less will need to be Roth contributed. Now, if you're all about Roth and you're just going to contribute everything Roth no matter what, well, this doesn't really apply to you. But if your plan was to get $31,000 in tax deductions year after year, in 2026 moving forward, you should plan on only the majority of that contribution to be tax deductible, whereas the portion attributable to a catch-up contribution will be Roth mandated to be contributed. And this is due to IRS Notice 2023-62, which basically says highly compensated employees need to have their catch-up contributions made as Roth, and a highly compensated employee is anybody making over $145,000, according to the IRS. And that number is also subject to go up with inflation over time, but we'll see what all the numbers look out to be as we get closer to 2026. And I'll link down below to the IRS notice if you want to go back to the source. Talking about catch-up contributions even further, there is a new rule starting in 2025 that allows those between the ages of 60 and 63, so for the 4 years you're within that window, to make super-duper catch-up contributions. I'll save this for a deeper dive in a future video as well, but just know that as of now, if you're aging into being 60 in the tax year of 2025, aka you won't be 60 until December 31st, this still applies to you, you're allowed to make a super-duper catch-up contribution when you're 60, 61, 62, and in the year that you are 63. And that super-duper catch-up contribution is an additional $11,250 as opposed to the $7,500 catch-up contribution. Now, you could still do $7,500 if that's all you want to do, but just know that you're permitted to go all the way up to $11,250. And that number is subject to going up over time as well. Now you don't get to do both catch-up contributions, $7,500 plus $11,250 if you're between 60 and 63. You would just have a maximum limit of $11,250. I personally haven't seen any hard and fast legislation on this, but my assumption is starting in 2026, those super duper catch-up contribution amounts will need to be Roth contributed as well. But I'm guessing for 2025, you're in the clear to make all of that pre-tax if you want to. And if your employer's 401k plan permits this. Employer 401k plans don't have to permit catch-up contributions if they don't want to. For those of you at very large companies like Amazon, Meta, Microsoft, GE, etc., you're also permitted to make what are called after-tax 401k contributions. So this segues into a different increased number for 2025. The increased number this year is what's called the defined contribution limit. The defined contribution limit has increased to $70,000 for the tax year of 2025. If you don't have access to an after-tax 401k plan, or you're not self-employed with a solo 401k plan, then this number won't be dramatically applicable to you. But if your employer offers an after-tax 401k plan, you're going to want to stay tuned. Ultimately, this is the number that dictates how much more you can put into a 401k plan above and beyond that $23,500 number. I'll cover in a future video exactly how to do this math, but long story short, the way to quickly determine how much you're allowed to put into that after-tax 401k plan, which is sometimes called the mega backdoor Roth 401k plan, is you take the defined contribution limit of $70,000, you subtract out how much you're going to put into your own 401k, which would be the $23,500, then you subtract out any sort of employer matching contributions, and that's how much room you have left to make into after-tax 401k contributions. Generally, the number is around $30,000, $40,000, somewhere in that ballpark. Obviously, if your employer matches more of your contributions, this hurts how much you can put into the after-tax 401k, but it's free money, so probably shouldn't be complaining. However, if you also are 50 or older, or you're in that age 60 to 63 super duper catch-up contribution amount, you're allowed to make extra contributions above and beyond what everybody else can. Your ability to make catch-up contributions also adds to the total defined contribution limit. So for example, if you're 50 or older and your catch-up contribution for 2025 is $7,500, that means your defined contribution limit isn't $70,000, it's $77,500. And then you're making that extra $7,500 catch-up contribution in your own 401k. So the math is the exact same, unless the employer match also increases because you put in more. The next tax limit to point out are the IRA contribution maximums, which for 2025 go unchanged. So that still means maximums to IRAs and Roth IRAs in total are $7,000. And if you're 50 or older, then you get an additional $1,000 in catch-up. There are updates, however, to the phase-out modified adjusted gross income levels. As a quick refresher though, if your modified adjusted gross income for a particular tax year, which is basically your adjusted gross income for shorthand, but there is a slight difference, if it falls between these two limits, then you're allowed to make a partial IRA or Roth IRA contribution. I'm going to cover the Roth IRA brackets because those are applicable to most savers out there. If you're single for the tax year of 2025 and your modified adjusted gross income totals to $150,000 to $165,000, then wherever you are in that spectrum, you are allowed to make a proportional contribution to a Roth IRA. If you're married filing jointly for the tax year of 2025 and your modified adjusted gross income falls between $236,000 and $246,000, if you're within that band, then again, you are allowed to make a partial Roth IRA contribution for both spouses. Next up is an increase to the Social Security taxable wage base. Now, most taxpayers out there don't get to control their compensation. If you do get to control your compensation, this might be something to be aware of for those of you who are self-employed or have a good amount of influence with the board or the owners of the company. But it's good information nonetheless to know how much of your total salary will be taxable for the purposes of Social Security, aka how much of your income do you actually get credit for by paying into the Social Security system. And that number is $176,100. What that means is if you make $200,000, $176,100 will be subject to all those FICA, Social Security taxes, and Medicare. Whereas the portion between $200,000 and $176,000, that will still be subject to Medicare taxes, but you're not going to get additional credit added to your Social Security determination. Now, I'm sure a future video is warranted on the efficacy of planning for Social Security in your retirement based on how old you might be, but we'll have to save that for another time. Touching on some gifting and estate tax maximums, the estate tax exemption for 2025, if you die in 2025, is going to be $13,990,000, which for shorthand, you could just use 14 million to keep it simple. That's what I've been doing. Not a huge change there, and I doubt it's going to dictate how much of somebody's net worth they do or don't accumulate for the tax year of 2025. But it nonetheless is good information to know if you're doing some preliminary estate planning that roughly 14 million on the federal level is probably a good planning factor. One cool increase though is the gifting maximum for 2025 is $19,000. This means that I, as a single individual, can give $19,000 to as many different people as I want to in a particular tax year. For example, in 2025, I could give $19,000 to 10 different people and gift away $190,000 of my net worth. If I'm married, which I am, I could double up those gifts and give $19,000 to 10 different people and then gift another $19,000 to 10 different people by using the gift splitting technique with my spouse, whereby the IRS just thinks if I stroke a check for $36,000, it's as if my wife and I both stroke checks for $19,000 each. One question I get a lot on the gifting exemption is if I gift more than $19,000, will I have to pay taxes on that? We'll have to touch on this more in a future video, but to keep it very simple, even if you gift over the annual exemption amount, that really only decreases dollar for dollar that $14 million federal exemption number we just touched on. So theoretically, if you gifted $14,019,000 away in a particular tax year, then any gift after that, you would then have to pay gift taxes on. But I'd probably recommend hiring some professionals before you start gifting away that level of assets. If the best financial planning software in the world is projecting that you're probably not going to have a net worth of over 14 million per person before you die, double that to 28 million as a family. If you don't think you're going to reach those thresholds before you die, then you probably don't need to worry about gifting more than the annual gift exemption of 19 grand. But keep in mind, estate tax exemptions are subject to change. And up until the most recent results of the election, the best minds in finance were predicting those federal estate tax exemptions of 14 million per person to be cut in half to 7 million per person, and potentially even further. So more to follow. Lastly, let's touch on health savings accounts. The maximum you can contribute to a health savings account depends on whether you're in a single plan, family plan, and or if you're over the age of 55. For a single health plan, your maximum contribution is $4,300, which is all tax deductible. If you're on a family plan, your maximum family contribution is $8,550. And if you're 55 and up, you get an additional $1,000 in catch-up contributions to either the single or the family plan. Keep in mind, if you're with a company that's providing really awesome benefits and they're going to give you free money into your health savings account as like an ipso facto match, just know that your annual limit is decreased by that amount of match, which is a good problem to have because it's free money. Yes, you don't get the tax deduction, but I'd much rather have free money than tax deductions. Okay, so from a calls to action standpoint, I'd highly recommend reviewing what you are on track for contributing to these various types of accounts. The biggest one that's applicable to most people is the 401k, because that is really the workhorse behind a lot of people's ability to save money for retirement. I would go do some simple back of the napkin math. I would take the total 401k contribution limit, $23,500, or if you're 50 and up, there's more. If you're between 60 and 63, there's even more, and divide that by your projected compensation for 2025. That will give you the percentage of your compensation that you're going to want to withhold if you want to max out these plans within the calendar year. Now that number may or may not be doable. Just know that that is the ceiling basically. Now, of course, you could always put in all of the contributions in January or February, or really load up the 401k plan January through April and then be totally done contributing for the rest of the year. And that works out a lot of times for people who are highly compensated, who want to get all the money into the plan immediately. But just keep in mind that there's a potentiality if your third-party administrator doesn't catch it, you might make over contributions for the tax year that you're contributing. And then there's this whole rigmarole I'll link above here as to the course of action you're going to want to take if you over contribute to a 401k plan. This also applies to those of you who are making after-tax 401k contributions. I'd go back and make sure that the math has you funding the 401k plan primarily and then filling up the after-tax 401k plan. You might need to adjust some percentages. Of course, if you work with an advisor, they can absolutely help you with this stuff, but if you're doing it on your own, those are just some simple back-of-the-napkin math stuff to do. In addition, I would go look at your income projection for the tax year and see if you are currently funding an IRA, either pre-tax or Roth, whether or not you'll still be able to do that based on the phase-out ranges. I'm a big fan of kind of just waiting until April before making contributions, or if you know you're going to be over the limits anyways, just knocking out a backdoor Roth IRA at the beginning of the tax year every year for that tax year. But it's something to be mindful of if you're going to do some more contributions to retirement accounts other than just the 401k plan. Hopefully that was helpful. If you have further questions, drop them in the comments below or get in touch on the website. We'll help you get squared away. Have an awesome rest of your day, and we'll talk to you later, and have an awesome 2025.